Hola mi gente, welcome back to the channel. My name is Sean and this is We Are Investing, a channel that's dedicated in investing and personal finance. On today's video, I'm going to show you how to sell a poor man's covered call on Robinhood. We're going to go over the strategy, why I love it so much, and how to do it. Now, if you're interested in content regarding the stock market, cryptocurrency markets, and investing overall, then definitely consider hitting that subscribe button, ringing that bell, and smashing that like button. When you ring that notification bell, YouTube will notify you when I upload more videos. And also, please be aware that if you're new to investing and you're looking for videos on how to do certain strategies in Robinhood, in Thinkorswim, or wherever, there are multiple playlists down below in my channel that will help guide you through the process. Now, I'm filming this video on February 24th, the day that we got news that Russia invaded Ukraine. And as you probably guessed, the stock market went tumbling at open. We saw the NASDAQ drop 3.5% in one day just to recover and then gain 3.5% by close. It was a crazy day in the stock market. But the reason why I wanted to bring that up in this video is because what did I do right at open? I bought more leaps so I can sell poor man's covered calls in the future. This is the primary way that I invest and trade in the stock market. It is through long dated call options that I then use as leverage to sell poor man's covered calls while also collecting the returns on the upside for these stocks. If that's too much to understand, I'm going to explain in further detail in this video as well. Now, before we proceed, just be aware that Robinhood right now is currently running a promotion that if you sign up with the link down below that I'm providing you, you can get free stocks worth up to $200. Now, I'm briefly going to go over what a covered call is because that's fundamental in understanding what a poor man's covered call is. And this is going to be real brief. I did a video where I went into more detail regarding covered calls. I'll link that video down below. It's also within the Robinhood investing playlist. So in order to do a covered call, you need to have 100 shares. You don't need these 100 shares for a poor man's covered call, but you need something else in return. You need a long dated call option. We'll dive into that later in this video. But let's say you have 100 shares. I have 100 shares of SNDL. I wanted to do a covered call, which is selling a call option against my 100 shares. So you hit trade options, and then you look for the expiration date. In the example we had July 15th, I believe. And we can see that the $1 call option is trading at $7. Essentially what I can do is I can click sell call. I can sell that call at $7. And because I have 100 shares of SNDL, this is money that I get to keep forever. With a covered call, you collect the premiums up front. And the only downside to selling a covered call is that if SNDL is above $1, I either have to sell 100 shares of SNDL at $1. Doesn't matter if the stock's trading at $1.10, $1.25. If it's above $1, I have to sell it at $1, or I have to buy back this call option before it expires. But when we did the math here, so this is trading at $7, SNDL is currently trading at $50. So when we do the math here, 7 divided by 50 is a 14% return by just selling that covered call, and then also a 50-cent increase to get to $1 from a stock price that's 50 cents right now. That's 100% upside. So SNDL has to go up 100% for me to then have to sell stock at $1. So you get to reap the benefits to the upside. You get to collect and keep that premium. The only downside is you miss out on some potential returns if SNDL goes above the strike price, which is $1. Now that's how you do a covered call. I'm going to show you the power of a poor man's covered call right now. So with a poor man's covered call, you're not going to actually need 100 shares. The reason why it's called a poor man's covered call is because it costs less money to be able to sell call options against your position. With a covered call, you need to buy 100 shares. For SNDL, it's $50. For a poor man's covered call, what you're going to do is you're going to buy a long-term call option that's in the money. And let's look at what it would cost us for SNDL. So instead, we're going to go to trade options, and we are going to select the expiration date that's the furthest out. That's January 2024. And the lowest strike, the deepest in the money we can get, is 50 cents. That's trading at $28. Something else that you need to consider when selling poor man's covered calls is you need to take a look at delta. If we click on this strike, we'll see that delta is 0.77. Usually I like to be at 0.8 or above, but this is close enough. Delta just corresponds to the increase in premium per $1 increase in the stock. As the stock goes higher and higher, so will delta, and you'll be able to capitalize more on the upside move. We'll explain that in more detail later in this video, but I want to show you the most important stuff. So the reason why it's called a poor man's covered call is because this cost me $28. And if I was to buy this long-term call option that's in the money, I could sell that $1 strike against it. Now the math in this equation has completely changed. Instead of buying 100 shares at 50 cents, so $50, and then selling that call option which brought $7 in returns, I can do the same thing and only have to put down $28. So the returns here are 7 divided by 28, and instead of 14% returns by selling those call options, we're going to get 25% returns by selling that same call option. That's the amount of return we're going to get just in premium. Now, a poor man's covered call, if SNDL was to get to $1, you're not going to get the same amount of returns as a covered call. Remember that delta was 77. So instead of collecting that entire upside move, you're going to collect around 80%. But as delta increases, that number will increase as well. So it's almost impossible to be able to determine how much money you will collect on the upside, but give or take around 80%. Now, it's unlikely that SNDL is going to get to $1. So I'd rather take more money in premium upfront on a return on investment standpoint and take less money potentially if it was to get to $1, which is a 100% move in just a couple of months, which is very, very unrealistic. The chances of that happening are slim, and that's why I rather collect more premiums by selling poor man's covered calls than doing a covered call. Now, something else you need to know is that with a poor man's covered call, you don't physically own the stock. So unlike a covered call where you actually own the stock and you can collect dividends, you won't get dividends with a poor man's covered call. That's something you have to add into the equation. If the stock you're looking at pays a nice dividend, then maybe it's worthwhile to do a covered call instead of a poor man's covered call. In addition to that, because you are investing in a LEAP, which is a call option that expires way down the road and typically is in the money, it has to be in the money if you're going to do a poor man's covered call, you are going to have more volatility. On good days, you're going to have better returns. On bad days, you're going to have bad returns, worse than if you had stock. So if volatility is not your thing and you can't handle it, then maybe it's better to do a covered call instead. Also, you're putting a timeline on your investment, but you can always roll these options. You can keep on extending them further out and out and out. Every single year, you're going to get another LEAP that comes out. You can sell this call option and then buy the call option that's further out in expiration. Now, we'll go over another example. We'll go over an example that I'm actually doing. I'm not buying SNDL, but it's an easy one to show you. But before we do that, I want to head over to the computer and show you some things regarding poor man's covered calls. Now, I use the term LEAPs a lot in this video. LEAPs are long-term equity anticipation securities. They refer to publicly traded options contracts with expiration dates that are longer than 1 year and typically up to 3 years from issue. They are functionally identical to most other listed options, except with longer times until expiration. A LEAPS contract grants the buyer the right but not the obligation to purchase or sell the underlying asset at the predetermined price on or before expiration date. Typically for me, when I'm buying LEAPs, I'm buying the furthest expiration date out that I can, and I'm buying the deepest in the money that I can afford and works well for my portfolio. I'm keeping in mind delta. I want delta to be around 0.8 if I can afford it. If I can't, I'm willing to go a little bit lower. If I can afford more, I'm willing to go higher in delta. Now, because leaps are so long term, there's essentially no theta decay, and they're not going to be as volatile as shorter term options, but they are going to be more volatile than buying stock. Now, I wanted to show you a website that actually put this down on paper just in case you learn better that way. Now, a poor man's covered call has two steps. You buy an in the money call option with a long term expiration. This is what I'm referring to as a leap. Then what you're going to do is you're going to sell a out of the money call option with a near term expiration. You can do this for the weekly, you can do this a month out, you can do this 2 months out. You get to pick what expiration you want. But the shorter the expiration or the closer it is, the more frequent you're going to be able to use this strategy and create income by selling options. Now, the in the money call option substitutes for the long stock position. The leap substitutes for having to own 100 shares. Since you can exercise it to deliver stock if the out of the money call option goes in the money. In addition, the net premium paid for the in the money call option is a fraction of the cost of acquiring the underlying stock. Now, the poor man's covered call has too many variables to calculate a specific maximum profit or break-even point, but there are a few ways to make reasonable, accurate estimates. The max profit is approximately equal to the difference between the call strikes minus the debit paid to enter the position. The call strikes are is the strike price of your leap option, which is 50 cents, minus the strike price of the short-term option, which was $1. The debit paid is how much you paid for the leap minus how much you got paid to sell the call option. So in our case, it's $28 minus 7, so $21 is our debit paid. The break-even point is roughly equivalent to the long strike price plus the net debit paid to enter the trade. So the break even on the long-term contract, and this is really easy to understand, but not the break even on the poor man's covered call. The break even for the leap is just what you paid for the leap plus the strike price. So we had a 50-cent strike plus a $28 premium. So our break even for that contract is 78 cents. If SNDL is above 78 cents, by expiration, that contract is going to be profitable. But this is going to change dramatically with how many times you're able to sell call options. If every other month we're able to sell a call option and collect $7, that's going to be a hedge and lower our break even to a point where SNDL can drop and we'll still make money because of how much money we made every single month or week by selling call options or poor man's covered calls. The max loss is equal to the total net debit paid to enter the position. The max loss for this strategy is just what you paid for that leap contract, so $28. You can keep the premium and either sell the long call or write another call option to generate more income. And this is what we're all about, continuing to sell poor man's covered calls and essentially making your position an income stream for you. That's the goal. Now I'm going to go over one more example, and it's going to be real quick, and I'm going to show you what I actually own. I don't own it in Robinhood, I own it in a different brokerage, but I'm going to go through the steps. The stock is Uber. So if we search for Uber, we click on Uber, we're going to hit trade, we're going to hit trade options. Now today I bought a leap in Uber. So we're going to go all the way to the January 19th, 2024 expiration date. I'm buying it in the money, so I got to go down. The current strike price is $34.25. I bought the $25 call. It's trading right now for $13.28. So to get into this trade is going to cost me $1,328. Because Uber's trading at $34.25, if I wanted to sell a covered call, I would have to buy 100 shares instead, and that would cost me $3,425. So I'm getting a significant discount while still being able to sell poor man's covered calls. If I click on the strike, you can see that delta is 0.79, just close enough for me to actually want this position. Now keep in mind the cost, $1,468. Sorry, I read the cost for the $27.50 strike instead. So $14.68 is the cost. We're going to click buy call. We'll click on that. We're going to have a long call. We'll hit continue. We're going to do one contract. You're going to review it, and then you'll swipe up. I'm not going to actually buy this call option, but I want to show you the process. Now, to sell a poor man's covered call, once we have that leap actually in our portfolio, we're going to sell and we're going to click call. Now, I can select a call option. If today or the next expiration is February 25th, I can go a month out, go March 25th. The current stock price is $34.25. Now you're going to want to do some technical analysis. You're going to want to sell a call that's above a resistance, making it less likely for it actually to get in the money and for you to have to sell your leap, because you want to be able to hold your leap for as long as you can and just rinse and repeat this strategy. But let's say it's the $40 call. Well, right now you can get $63 for selling that call option. So $68 for a position that costs us $1,468 is around a 4.6% return in just a month's time by selling that covered call. In addition, you also are able to collect on the upside. So with Uber being around $34, that's a $6 increase. You'll be able to collect on around 80% of that upside move as well. So 6 divided by 34 is a 17.6% upside. And let's say you collect 80% because that's around delta, you'll collect a 14% upside. You'll collect 14% of that upside while also getting to keep the premiums. If you have a portfolio where you don't have a ton of money, but you still want to be able to sell options, you still want to be able to collect monthly and weekly income by options trading, poor man's covered calls are great ways to do it, but only buy leaps in companies that you like for the long term. Finding a leap that you like is more important than finding a poor man's covered call, because when you hit on stocks and you have leaps, you are going to reap the rewards. Leaps are so powerful in themselves, but when you sell poor man's covered calls with your leaps, you're just adding to the returns. At least that's my opinion. Now, if you have any questions, you can join the Patreon. It will give you access to a private Discord server of over 500 investors where you can contact me or the other investors every single day. We talk about stocks and cryptos every single day. We notify each other when we buy or sell anything. There's a dedicated channel that whenever I add or close to a position, I will notify you all on that channel. So you can follow what stocks I'm buying and selling and other members as well. That wraps it up for this video. Let me know if you are selling poor man's covered calls, if you like options trading, and if you invest in leaps. Let me know in the comment section down below. Hit that subscribe button, ring that bell, and smash that like button. And I'll catch you all on the next video. It's been real. It's been fun. It's been real fun. And this is We Are Investing, and together we are invincible. See ya.